Hello again, everyone. This is Greg Towner with Parallel Portfolios, and welcome to the November Market Outlook call. This month, we're going to take a look, as we usually do, on an update on the stock market price trends. I also want to get into a little bit of what is driving the global market stock rally that we've been enjoying. We're going to tie that into an economic update, and then we just want to do a little bit of a reminder of drawdowns or corrections and how often they can occur. So let's jump right in and look at the S&P 500, the U.S. stock market over the last couple of years. As we've been saying for all year, basically, a nice steady uptrend. Last month when we spoke, we were worried, not worried, but, cautioning that they were a little bit extended from the trend, maybe it can pull back. Well, it rallied up. We just in the last week had a very minor pullback. It didn't even go as deep as some of these others that we've had. And then just today, actually, we had a bit of a rally after this very minor correction. So the uptrend continues here in the U.S. markets. But what about abroad? This is an international developed market index. Again, very similar, that the recent pullback was just a little bit deeper, but still very minor in the big scheme of things. Uptrend continues. Nothing that worries us too much at this point. Beyond just the usual minor corrections, and we'll of course be watching those. So what are some of the things that have been driving the market? There's lots to talk about, all these different things, but really when you boil down to it, earnings has been a key. If we go back to 2010, coming out of the financial crisis, if you look at this dark blue line here, this is a global stock market index. You can see we had a nice move higher, and just at the same time, this kind of greenish line, the earnings estimates were moving along right with it. We had about a 2-year period there in the 14, 15, even into 16 a little bit, where the stock markets generally paused, corrected a little bit. Well, not so coincidentally, that's also when earnings paused. Now we've seen a nice surge higher in earnings, and stocks have been moving higher. So the forward estimates continue to be healthy. Here in the U.S. in the third quarter, those numbers are just about wrapped up. Looking like we're going to have about a 9% growth number in earnings, very healthy, and that even includes a bunch of large write-offs from insurance companies due to the hurricanes. If you were to exclude that, it was closer to 12%. So we certainly don't expect those kind of growth numbers going forward, but it just shows some of the growth that we've been enjoying in earnings. So where's all that earnings growth coming from? Well, of course, some of it is from companies cutting costs or using cash to buy back shares, those sorts of things. But really, global economic growth is the key part. So let's look at this chart going back more than 10 years now. And just to summarize it, the red is when worldwide economies are contracting. Different countries are contracting. The light green is when they're growing, but at a decreasing rate. And the dark green is when countries are growing at an accelerating rate. So we can see here in 2017, we have no contracting major countries. Most of them are accelerating their growth. The estimates for next year are similar. Of course, estimates are just that. We don't know for sure. But we got to go back 10 years to see where we didn't have major economies that were contracting. So this explains a lot of the growth that we're seeing. Positive economic data is driving earnings in part. Helping drive the stock market, which of course there's always a lot of things that affect equities and interest rates, but certainly earnings and economic data are key. So all those things we talked about are quite positive, and the market's been chugging along, and sometimes we worry that investors might get a little bit complacent with things. Maybe that happened just as recently as a couple of weeks ago, and then we saw the sharp little, not even sharp, but just a minor little correction that we had. And basically, we saw sentiment shift real quick. People got really worried quickly. So what we wanted to show you is a chart. We've shown something similar to this in the past. This goes all the way back to 1980. Each individual year is represented by one bar, and that's the return to the U.S. market in that individual year. The red dots and numbers below represent the maximum correction in that year. So the average annual intra-year decline is about 14%. This year we've only had 3%. If you go back over time, we had another year here in this bull market that was only about 3%. Handful that were in the kind of mid to upper single digits. Certainly a lot of them in the teens or even occasional larger. So we show this as just a reminder that what we've been experiencing recently is great. It won't always be that way, but just because when we do have more notable corrections, it doesn't mean that the world's coming into an end or there has to be a crash. I mean, these crashes are painful and they occur, but they're very minor. Most corrections are just that, corrections within the broader perspective. So just wanted everybody to keep this in mind. So that's a brief update from us here at Parallel. Again, in summary, stock price trends remain strong throughout the world. Markets have been boosted in large part because of the earnings growth, which at this point we see continuing. A lot of that has been boosted by worldwide economic growth, not just here in the US, which we've been talking about quite a bit this year, but actually internationally is picking up speed, and that's driving a lot of growth as well. And then as we just talked about, a reminder that drawdowns or corrections are a normal thing. They will happen in the future, so be aware of that. So we thank you for joining us. We hope that everyone has a great Thanksgiving next year, or the next week rather, and we'll talk to you again next month. Thank you.